Hello guys, today I'm going to speak about Alteryx, which is a software company providing, let's say, automation process uh, for reporting. Uh, this PowerPoint is based on the last update on Q4 2019, and the current share price actually is $95. So let's dive in into the revenue. So over the last 4 quarters, the revenue has increased from 76 to 156.5 million, which was a really great quarter, the last quarter. As you can see on the left, these are the gross margins here for each quarter. 1, 2, 3, 4. You can see a slight increase from 89% to 92%. And also the most important to understand here is that the last quarter was had a net income, a positive net income. So this is the first quarter where the company is profitable. So it's a great news. Also, you can see on the last graph the percentage of research and development and sales general and administrative ratios compared to the overall revenue. So as you can see, there's a decrease over the quarters as the revenue increases. So this is a sign of operating leverage. So this is very interesting, and we will be going into details on the next slides. Now let's go to the balance sheet. Here I tried to summarize basically over the last 4 quarters. So you will see for each tick, like the dark gray is Q1, the light gray is Q2, the third tick is Q3, and then the last one in color is the Q4. So actually you can see the evolution of each of the items in the balance sheet to see how the company is going to. So there are a few points that I would like to mention about the balance sheet, which is first the total long-term liability, so the long-term debt. I believe on Q3 they made like let's say loan, which increased like the debt from let's say 50 million to 670 million something. So they raised money for the internal growth, which is quite typical for growing companies. Now what is important is to see the balance between the debt side and then what they have in terms of cash. As you can see on the cash equivalents, they have 410 millions. On the short-term investment, they have 377, and on the receivable, it increased a little bit, up to 148 million. What is quite important to see is like how the cash flow is used, and basically from the Q1, there was an increase. So basically, it's because of the debt increase they cashed in. But basically, the last quarter, you can see a cash equivalent decrease from let's say 640 to 410, but basically you can see directly that they put all this cash into short-term investments, so it jumped between 220 and 377. So as I can see here, I don't see any issue on the cash side. Now we can go on the cash flow statement. So same on the left, you can see that the four last quarters, and on the right, the last 4 years. What is important to see is that you have three components into cash flow statements: operating, which is in green; investing, which is in yellow, which is related to capex; and financing, which is related to let's say raising money. So as you can see over the last quarters, so from it's cumulative, huh? So this is on like the last quarter is the last Q4 is the last quarter of the year, so that's the final values that you will see also on 2019 here. As you can see, over the last 3 years, the company has raised a lot of money. Basically, it was all financing related cash increase from 136 to 216 and then 564. Also, you can see that the operating cash flow is quite minimal, but increasing in this case. So the reason why it's the case is that the company is probably investing a lot into R&D and in SG&A, which is reducing the net income and then impacting also the operating cash flow. Overall, the investing part remains quite steady. So we can expect maybe in 2020 to be a similar type of configuration. However, the cash flow is quite significant, so they might not need another raise for the next year or two. Now let's look at the share outstandings, just to have a quick look. Over the last quarters, 4 quarters, the share count increased by 4%, and over the last 4 years by 16%, which is quite acceptable for such a growing company, which sometimes dilute a lot. So this is not too much of a concern. Now the next slide is one of the most important, is the summary. So what is quite important to see here is actually to identify what is the, let's say, profitability rate of the company. What is quite important sometimes is not to do like a DCF, but I want to identify all the characteristics of the company, and this table summarizes everything. As you can see, the first table here is related to the last 4 quarters. So this is an average of the last 4 quarters. So basically, I calculate the enterprise value based on the market cap, working capital, a long-term debt, and long-term investment, which gives a slight different value compared to the market capitalization at the moment. The overall earning are 27, and then the depreciation is 8. So basically, we have a free cash flow of 27 million. When I divide it by the enterprise value, it gives me a ratio, let's say. So that's basically the profit ratio. And I apply the same for the last quarter, which gives me a 1.5% ratio. So now what is important to see is how much did they reinvest from the gross profit into the R&D. So what I like to see also is without the R&D, what would be the ratio, which actually here is 2.6%. This is quite interesting because this is a growing company, but it is already profitable. Now related to the price to sales, price to EV, and price to cash, they are quite high. That's why they are in red. But basically, their revenue growth is around like 50%. So you can expect next year a price to sale to be, let's say, maybe 30% less. So for a growing company, this is not too much of an issue as long as the company is growing. Also, as you can see here, there's a lot of cash per employee, like $963,000. So over the next year, with this, let's say, slowdown in the economy, we don't expect any, let's say, people getting fired because there's a lot of cash available for the employee. Also, you can see the different gross margin, operating margin, and net margin are quite comfortable. So the company is in a good shape, let's say. What is the most important for me is when I look at growing company is to see if there's an operating leverage. So basically, when I see a revenue growth increase, I want to compare also with the operational expense increase. And if I like the company is increasing by 100%, but the OPEX are increasing by 150%, basically we don't expect to have this company give more margin in the next years. That's why I'm looking into 2017, 2018, 2019, and looking at the different revenue growth and OPEX growth. And as you can see, for each year almost, apart from 2019, there's like a significant room between revenue growth and OPEX growth. And this line is between 2017 and 2019. The company grew 387% on the revenue, but the OPEX only increased to 167%. So there's a high operating leverage. So if the company continues in this way, we can expect to have a better earning ratio. And in this case, it can be a very good bet. Okay, so to summarize, for me, the big plus of this company is first the client database that actually represent the big moat. As soon as you install a software and you get this used to, it's quite difficult to change from a software to another one, to get reused to the stuff. So as it simplifies the reporting system, I believe the clients will stay with the company for the next years. Also, the company is already profitable with a high operating leverage. So this is quite very important for this growing company. The business also it's quite light type, like as a software company, very high gross margin and little, let's say, few assets, which make it very adaptable and flexible. And also the cash available per employee gives a lot of room to avoid a dilution, a debt, like money raising, and also loss of employees over the next year. That might be a difficulty. So I think that's it. If you have any question, just post a comment and then see you next time. Thanks.